Hi there, I'm Champion Trader Kevin Davey, and I'm back with 4 more trading traps to watch out for in 2024. So let's get started. First, U.S. government disclaimer: don't trade with money you can't afford to lose. Past performance is not indicative of future results. Treat all results as hypothetical. And 4, remember that trading systems are usually built with the benefit of hindsight, and that is a bias that skews them towards profitability. So remember those 4 disclaimers. All right, so for those of you who don't know me, I'm a trader, author, and educator. Over 30 years trading experience. I finished 3 years in a row in first or second place in a highly regarded futures trading contest. Had over 100% return per year. And that's a year-long contest, and it's real money. So it's not one of these fake contests that's out there. This is the real deal. So let's talk about games people play. Now, if you haven't seen the previous video, you should go back and watch that. I give you 4 trading traps. This one I'm going to give you 4 more, but they all revolve around a few different concepts. One of them is, if it's too good to be true, it probably is. No one's going to sell you the Holy Grail. People do give you good education and can give it to you. But if you see something that looks too good to be true, it's time to run. Okay? And my rule of thumb is just treat everything you see out there as hypothetical. If it didn't happen in your account, well, then it's hypothetical. Okay? If it happened in your account, well, that's real. But even if it's your crazy brother-in-law who's always talking about how great his trading's going and how you should just follow what he does and you'll make the same returns as he does, no, not necessarily true. It's hypothetical to you. Might be real to him. It's hypothetical to you. So remember that. Okay, so let's talk about what some of these trading traps are, why they're bad, how we can avoid them. So the first one is called look inside bar backtesting, at least in TradeStation. Some other software calls it bar magnifier, bar resolution. And it's a pretty sneaky thing. And a lot of vendors out there who show trading results take advantage of this. Okay? So let me explain it to you. Let's say you had a signal bar there, and there's your open, high, low, and close. Okay? And you decide to buy at the close. Your signal got hit, okay? You're going to put a stop and a target around that entry. But you don't know what the next bar is going to look like. So you put your stop at the bottom of the current signal bar. A lot of people do that. And you put your profit target a little bit above the high. That's just fairly typical, but it's just an example here. Well, let's say that next bar looks like this, where during the bar, your stop would have been hit and your profit target would have been hit. Well, which one was it? It can't be both, right? Because the profit target and stop loss are an either or proposition. The first one to get hit takes you out of the trade, and the next one just disappears. It just gets canceled. So how do you know which one got hit here? Well, the trading backtest engine, no matter what trading software you use, also has the same dilemma. It doesn't know, so it has to make certain assumptions. And I won't go into the details of the assumption, but in this particular case, it's going to assume that you exited with a profit. So you go back, look at the backtest. Hey, this was a profitable trade, and you give yourself a thumbs up because you're so smart. But the reality is you really don't know what was hit first unless you employ what's called this bar magnifier, bar resolution, or look inside bar backtesting. Because let's say this is what the bars inside, in between those 2 bars, look like. Let's say the price right after you bought it went down and hit your stop, and then it went up and would have hit your profit target and then came back down again. And you might say, oh, well, it's never going to go down and up and down. Happens all the time. So put that thought aside. In this case, when you look through every bar on the path to generating this bar on the right, the actual trade is unprofitable. So what does that mean for your backtest? Well, it's like a double whammy. Not only did you not get the profitable backtest, but it was a losing trade. So imagine if you have 10 or 20 of these within your backtest, 20 trades that you thought were winners that turned out to be losers. It's going to really skew your trading results. So this is a trap people fall into all the time. And the unscrupulous vendors out there, they'll take advantage of this. And they'll show you great results and a great looking equity curve. But when you use this look inside bar backtesting, the performance turns bad. Okay? So, again, it's bad because the backtest engine makes certain assumptions and they might be incorrect. Watch out if you're dealing with a scalping system where it's a couple ticks profit, couple ticks loss, because those are the ones that fall victim to this more than any other. Use look inside bar backtesting when you can. And speaking of scalping systems or day trading systems, they fall victim to this trap. And then in the other video, they fall victim to the limit order trap. They fall victim to the commission and slippage trap. And they fall victim to the over-optimization trap. So one reason I don't trade scalping systems is because of all these issues that can come up with them. So watch out if you're presented with or you try to develop a scalping system, because a lot of times the results you get are not going to match your real trading results. And it's almost never in a good way. It's whatever results you think you're going to get is usually a ton better than what you actually get. Okay, so number 6, trading trap number 6. I also call it games people play. A lot of people will show you performance of closed trades only. The best example of this is former New York Met, and I believe he played for the Phillies, a baseball team, Lenny Dykstra. He ran, after he retired from professional baseball, he ran an option picking service, and he claimed he was winning 90% of his trades. And guru Jim Cramer, I'm sure you've heard his name, he once said Lenny's one of the best ones in the business. He thought Lenny was great. Well, Lenny was great when you looked at only his closed trades. What he was doing was he was burying his open trades. So he would show you a closed equity curve, but he wouldn't show you what his current open trades were. And usually his open trades were big losers. And he might have also played the game, I don't know, that if he was rolling positions, he never counted those until they were completely done and likely a winner at some point. But interim, there were all these losers and all this drawdown. He actually went to prison. So watch out for people that only show you closed trade results. It's completely misleading. You've got to do what's called marked to market accounting. That gives you at any point in time your open equity and your closed trade equity as a combination, because that's what's important. Not just your closed trades, it's your open trades too. So make sure you look for that in performance reports. In TradeStation, for example, they do have a closed trade equity curve, which is very useful for things. They also have a detailed equity curve, which shows the open trades with it. So take the time to look for this trick. Trick number 7. A lot of people will show you results that are just not achievable. Here's an example. This is orange juice. This is a number of years ago, but you get the idea, where there was this huge drop in orange juice and there's no volume. I mean, it immediately went from this price. The next time it was traded was this price. And you might say, oh, I have a limit order to buy at this point. Your backtest engine might actually tell you that you were filled there, and when in reality you couldn't have been filled. So these illiquid markets, these low volume markets, you got to watch out for it. The other part of that is if you're trading big size, you're not going to get the fills that you think you're going to get. You're going to get a lot of slippage. So imagine if you wanted to trade this market with 10 contracts. Well, look at it, it's barely trading one contract, usually zero for a lot of time. You're not going to get the fills you think you get. And the unscrupulous people out there might show you a great equity curve based on orange juice, but it's not going to be able to be achievable in the real world. A related comment is unrealistic pyramiding, where they show you buying every bar, you buy so much, and all of a sudden you have huge size. One, you're not going to be able to get out of those kind of markets if you trade this huge size. Yeah, you might be able to buy along the way, but at some point you got to liquidate it, right? And if you have a huge chunk of contracts to liquidate, the price you get isn't going to match the back test because you're going to get a lot of slippage as you're slowly getting rid of your inventory. This example, this goes way back to when I started trading. What got me interested in it, they showed an example of sugar, how if you had just bought so many contracts at every new high, you would have had $1 million or $8 million in profit. What they didn't say was you also would have had $1 million drawdown doing this. And when you finally exited it, it would have been pretty tough. So this is a trick that you got to watch out for just when you see equity curves out there. Make sure it's markets you can trade that are liquid and that don't have this kind of issue with them. Okay? Now, finally, before we get to number 8, just remember with number 7, the performance you see is pretty much going to be impossible, or it's going to wreck you emotionally. One way to avoid it is just avoid or at least limit your size in markets like orange juice, lumber. I think it was last year, I was trading lumber where it was doing limit up days, limit down days, and eventually I was just like, I can't deal with this. I just don't want to deal with this, so I stopped trading it. There's a lot of other markets that have better volume, so you don't necessarily have to trade these super thin markets. Okay, so let's look at trick number 8. This is if you're looking to have somebody manage your funds. I found this where they were saying how their great performance, how smooth their equity curve is, all the usual stuff. And then buried in the print, it says, hey, we trade 150 markets. So right there, it tells you they're diversified. Great. That's great. But the problem is, are you really going to be able to be diversified if you only have a $10,000 account? Probably not. You're probably not going to be able to participate in this kind of thing. So while what they're saying might be true with, hey, you can be diversified and get much smoother equity curve, the reality is for most traders, this is unattainable. Most traders have very small accounts when it comes down to it, and they're over leveraged. They can't really withstand any kind of significant drawdown. That's why the micro futures, the micro mini ES, those are great. Some of the other micro markets like crude oil and gold, those are starting to become good. You can trade those with smaller accounts. But the key to remember is you usually need more money than you think you do to trade these safely. Yeah, you can meet the minimum margin requirements, but that doesn't mean you're going to be out of trouble. Okay? The problem with this one, obviously, is they'll show you results, and again, they're hypothetical, but there's just no way that your account would be able to do it because you can't mimic what they're doing. And the best way to avoid it is be realistic about the margin you require, about the drawdowns you expect, and risk of ruin. If you don't know what your risk of ruin with the trading strategy is, you're going to get in trouble sooner or later because every trading strategy has a risk of ruin. Okay, so to sum up these last 4, and again, you can watch the other video to get the first 4, but watch out for look inside bar backtesting. Watch out for closed trade performance only. Avoid illiquid markets, and make sure you know what kind of account size you need to trade whatever scheme you develop or that you see for sale out there. And again, my solution, Strategy Factory Workshop, I encourage you to take a look at it on my website, and I think it'll help you quite a bit. All right, so that's it. Thanks for watching. If you like this video, give it a thumbs up. Leave a comment. I'm Champion Trader Kevin Davey. Have a great day.